You probably heard that we should diversify our income, right? Like don't put all eggs in one basket, and then you're presented with index funds, mutual funds, and ETFs. They're all diversified, and then you get confused, what should I choose? I've seen some friends, they put a lot of money in one of these without really understanding the differences. And later on, they found out that it wasn't the best choice for them, and switching to another one can cost you a lot of extra money, and it can be so stressful and annoying as well. So in today's video, I'm going to answer a few questions. What are index funds, mutual funds, and ETFs? And what are the key differences between them? And what are the key pros and cons for each option? And how can you identify what suits you the best? If you're new to my channel, my name is Charlene Cong. I'm a chartered financial analyst with 10 years experience in finance across Asia and Europe. I make videos on personal finance money tips, financial markets and investment, and career and personal development. Subscribe to my channel and you will be one step closer to your financial freedom. Let's keep it simple. What are index funds, mutual funds, and ETFs? First, you need to know there are different ways to invest in assets, right? For example, if you want to invest in the stock market, you have numerous ways to invest in it. Direct stock buying, what we call in finance is single security, same thing. Index funds, mutual funds, ETFs, derivatives, structured products, and so on. So for normal people, I would say direct stock buying, index funds, mutual funds, ETFs are the four main ways. For derivatives and structured products, I won't be talking about them here, and I don't suggest small investors touch it if we're not sophisticated enough. First, direct single stocks or single securities. It's like buying a specific company stock such as Tesla, Apple, Amazon, or Tencent in Hong Kong, UBS in Switzerland, straight to the point, right? I don't think I need more explanations here. Index funds. These are like copycats in the investing world. They shadow a market index, so index funds based on the name, they follow an index. Then you may ask me, what is an index, right? In general, a stock index is like the scoreboard of the stock market. So it takes a bunch of stocks, threw them together and gives you a single number to show how they are doing overall. Think of it like checking the average score of your favorite sports team instead of every single game. Some famous ones you might have heard are Dow Jones or the S&P 500. Index funds are pretty chill. They invest in the same companies as the index follows. If there are 20 companies included in the index fund invests in the 20 companies as well. They basically follow the index closely without getting too fancy. And finance professionals call this type of investments passive investing. So you can call index funds passive funds as well. Easy, right? Mutual funds. They are custom-made funds managed by professionals. Their aim is to beat the index, not just follow it. Mutual fund managers are like, index funds, you just follow the index, follow the market. What additional value you bring to the table? Nothing. I'm the stock picker. I pick the stock winners and get rid of the losers. That's mutual fund managers' goal. Outperformance or alpha, same thing. We call this type of investments active management. So mutual funds are active funds. ETFs, exchange traded funds. Imagine if the stocks and funds had a baby, that's an ETF. They trade like stocks but contain a mix of investments. For example, a bunch of stocks. You can buy them and sell ETF during the trading day. Easy access. So there you have it, the basics, no fuss. And then what are the key differences between index funds, mutual funds, and ETFs? I'd say they have more similarities than differences. They all invest in a bunch of assets, such as a bunch of stocks, right? And they're all to some extent diversified. How are they different from each other? Index funds, they're passive. They just mimic a market. No drama. When market goes up, it goes up. When market goes down, it goes down. Mutual funds, they're actively managed. There's a team deciding where to invest, a bit high maintenance if you ask me, and because of it being more active, it also costs you a bit more because those professionals, they need to do research, right? They need to do research on those companies they want to invest. They say, oh, they are very good companies, I'll invest. And after research, these are not the good companies, I shouldn't invest in them. ETFs, you can buy and sell them all day. Like trading a stock, it can be both active and passive. I know some people may tell you ETFs are only passive following the index. No, it's not true. If you put actively managed ETFs in Google, and you will find more information, and you can also subscribe to my channel. I will explain everything in my upcoming videos. What are the pros and cons of index funds, mutual funds, and ETFs? Index funds, the benefits of index funds are low fees compared to mutual funds, and prices are predictable, like your favorite comfort food. Index funds, the cons are no big surprises. If market's down, so are you. For mutual funds, the benefits of them are they are managed by professionals. They do the heavy lifting. For some really good ones, they can perform or return a lot better than the index funds. The downside of mutual funds are the higher fees that may not beat the market. According to data, 66% equity mutual funds underperformed their benchmark in 3 years. And if you're a mutual fund investor, you better be selective. You don't want something that are more expensive and also perform poorly, right? No guarantees here. And for ETFs, the benefits are the price is really cheaper than mutual funds, and it's super flexible because you can trade whenever you want during the day, whereas for mutual funds or index funds, you can only trade once per day. The cons of ETFs are just because ETFs are traded on stock exchanges throughout the trading day, this means their prices can change rapidly as well. For example, if suddenly so many people buy a specific ETF because of some great news in the market, the price can go up very rapidly. If suddenly, people sell ETFs because of some really bad news happening in the market, the price can go down quickly as well. So in other words, ETF prices can swing a lot based on market sentiment compared to mutual funds and index funds. The million-dollar question, which one is your match? Are you a set it and forget it person? Index funds might be your thing. Do you like the idea of professionals handling your money and you believe in active management? Go for mutual funds. Do you want flexibility and a bit of both worlds? Say hello to ETFs. But remember, it's all about what fits your goals and your comfort level. Globally, there were over 8,000 ETFs and over 130,000 mutual funds available. How do you find the right ones for you? Subscribe to my channel. Let's uncover it in my upcoming videos. In the meantime, you definitely want to learn the easiest proven way to get rich, right? According to the famous investor Warren Buffett. Don't forget to watch my video on Warren Buffett's easiest way to get rich, compound interest explained, where I break it down for you. Till next time, see you soon.